Hello traders, Gary Wagner here, just about 11:30 in Honolulu, 5:30 in New York. It is Thursday, September 21st, 2017, and this is the Daily Report for Gold and Silver. Even with a weaker dollar, selling continues in the precious metals, with gold trading off a cumulative of about $22 over the last 2 days, currently trading at $12.9430. Silver also under pressure at $17, down about 33 cents. And as I said, that all in light of a weaker US dollar, which is currently trading off by over 1/3% at 91.94. Traders, over the last 2 days, we have seen a $30 range in gold pricing, with gold currently trading off $22.10. I will call this the cumulative effect over the last 2 trading days, as it currently rests at $12.9430. The low that it hit this morning was just above $12.90 at $12.9120. And yesterday's high that it hit in overnight trading was $13.20. The key is we have definitively broken through not only the 50% retracement, but we have also broken and traded as well as closed below the 61% retracement, a standard deep retracement for any kind of correction that follows a rally. Given that we have a clear-cut path, in that for us to look at this market and continue to have a bullish model, we will see gold prices conclude in terms of their current fall at the lowest potential pricing of about $12.80 to $12.81. That comes out to the 78% retracement of the last leg of this rally, meaning as the market traded from $12.60 up until these highs at $13.63, a move to the area of $12.80 would be a 78% retracement. It would also be a 50% retracement of the entirety of the rally if we look at the move from 1200 up to the conclusion of that rally at 1263 and subsequent sell-off. And that's why we have 2 distinct and different marks. This mark here on the left represents this longer retracement, and of course, when we look at the 1281 at 78%, that represents the shorter of these 2 retracements, really beginning the rally down here. So inasmuch as this most recent correction has been extremely deep, extremely quick, I do believe that we do have an endpoint in sight, and I also believe that we are possibly not there yet. However, we are right within the realm of the area that we want to look at. And what I mean by that is that somewhere between current pricing and these lows at 1280 is absolutely where gold will find some sort of support, if in fact we are looking at any kind of a bullish model, which I still believe we are. And so the net result might be something like a first wave of the rally, subsequent correction very shallow, second wave of the rally, our wave 3, our deep and defined correction going anywhere in between the 61 and 78% retracement points, and then from there moving into a last final wave that will be roughly equal to the $80 move witnessed in the first leg of this rally. Therefore, my recommendation is to maintain a flat or neutral position, to let the dust settle, and to see how gold pricing reacts through the end of this week, maybe even the beginning of the next week, before initiating our next trade. And traders, interestingly enough, whereas yesterday we saw a tremendous upside spike in dollar value, you can see that on this daily chart. That's this candle right here. Today's downside move in gold was not caused by a rising dollar. In fact, the dollar was trading lower on the day, off by about 1/3%, and actually was supportive of gold pricing. In fact, when we look at the Kitco Gold Index, we can see that in terms of spot gold, which traded off by about $10 today, we can break that down into the fact that a weakening US dollar actually provided $4.40 worth of value, but selling was strong in the pits today as we saw gold trading off by $14.20, only to be tapered by a weakening U.S. dollar. Traders, in as much as we saw the Federal Reserve really surprise many traders, including myself, by announcing another rate hike this year to be enabled in December, it is the fact that they will begin their quantitative normalization process in October, which really carries the greatest amount of uncertainty. Commonly referred to as a stealth rate hike, it will have an effect on interest rates. However, the absolute effect is unknown. We want to watch closely over the next month to see the net effect of liquidation, although it will start rather small with the liquidation of about $10 billion in assets per month. This has been Gary Wagner wishing you as always good trading. We will talk to you tomorrow for another daily update and review. Bye-bye.